Welcome to Japan Market Brief, the daily English audio update on what moved Japan's markets and what matters next. April 1st brought a sharp rebound to Tokyo. The Nikkei 225 rose 5.24% to 53,739.68, reversing a large part of the previous session's sell-off. At first glance, that looks like a clean improvement in risk sentiment, but the better reading is that Japan's market received a relief rally, not a full reset. The most immediate support came from a cooling of the geopolitical shock tied to Iran. Japanese television and business coverage pointed to easing concern that the disruption would keep intensifying in a straight line, and that was enough to trigger strong buying after the previous day's damage. Wall Street also rebounded, with the S&P 500 up roughly 2.9%, which improved the external tone for Tokyo. Currency moves mattered too. Dollar yen slipped back to around 158.34, down just under 1% on the day. That does not mean the yen suddenly became strong, but it does mean the market stepped back from the most stressed version of the 160 yen story. When the yen stops moving in the worst possible direction, Japanese equities get room to stabilize. Still, there were signs that investors should stay careful. The topic's proxy data in this workflow remains noisy, so the cleaner read comes from the Nikkei, the yen, and U.S. yields. The U.S. 10-year yield edged lower, and cross-asset signals stayed mixed rather than decisively bullish. That is another reason to read today's move as a rebound built on relief, not a broad all-clear. The Bank of Japan Tankan gave the market an important domestic check on optimism. Large manufacturers improved for a fourth straight quarter on the current reading, but their outlook deteriorated. That split matters. It suggests companies are not describing current conditions as a collapse, yet they are still cautious about what comes next. For investors, that means Japan's market is still balancing two conflicting forces. One is headline relief, especially when energy and geopolitical anxiety fade. The other is a slower-moving concern about costs, demand, and how much confidence companies really have going into the next quarter. There is also still inflation pressure in the background. Tokyo consumer prices and the latest reports on April food price increases both argue that cost pressure has not disappeared. So while the market rallied hard, the macro debate around the Bank of Japan is not over. Today's stock to watch is INPEX. NHK reported that INPEX will prioritize sales of one Australian crude grade to Japanese companies. That may sound like a narrow operational item, but for the market it lands at exactly the right moment. Japan has been forced to think more seriously about energy security, as Middle East supply risk and shipping disruption have moved prices and investor sentiment. In that setting, INPEX is not only an energy producer, it becomes part of a wider policy and supply security story. If Japanese buyers can secure more stable non-Middle East crude, the market starts to value INPEX not just as an oil price exposure, but as a strategic supplier. This creates an interesting tension for the stock. If the Iran premium continues to fade, some of the simple crisis bid for energy names may cool. But if Japan's energy diversification drive keeps accelerating, INPEX can remain relevant for a different and potentially more durable reason. Another notable company story came from KDDI. A special investigation committee said that weak oversight contributed to fictitious transactions at subsidiaries, and NHK reported that roughly 330 billion yen flowed outside the company through the issue. Executives resigned after the findings. That is important because it reminds investors that even on a strong market day, governance quality still matters. In other words, April 1st was a day when the index looked strong, but stock selection still mattered. Energy security helped INPEX stand out, while governance risk kept pressure on KDDI. The next session will test whether today's rebound can hold. There are three immediate checkpoints. First, whether the Nikkei can keep buyers engaged after such a large one-day bounce. Second, whether dollar-yen stays away from the most stressed recent levels. Third, whether domestic indicators begin to support the stronger equity tone instead of contradicting it. If oil headlines stay calm and the yen remains stable, Japan can extend the recovery. But if the market swings back to inflation pressure, weak corporate outlooks, or renewed geopolitical risk, today's move may end up looking more like a sharp squeeze than the start of a durable upswing. That is all for today's Japan Market Brief. Thanks for listening.